Here, I would like to welcome on stage Alex Rosen, a managing director of Reach Ventures, which is formerly known as IDG Ventures. The firm has about over 400 million under management. Alex has been working with early stage companies as an active investor and an advisor for over 20 years. His focus is on investments in cloud infrastructure, SaaS infrastructure, ad tech, and consumer marketplaces. His investments include AppBoy, Chubbies, Datanize, Fastly, Indiegogo, and Prism Skylabs. Alex holds BS degree in electrical engineering and economics from MIT and MBA from Stanford University. Welcome, Alex, and I would like to welcome our old-time friend and supporter, Cromwell Schubarth, who is the TechFlash Silicon Valley editor at Silicon Valley Business Journal. Welcome.
Thank you.
Good afternoon. Good afternoon.
How are you?
So she touched on a bit about the name change. So let's start there. You were IDG for a long time. I guess you started this firm as IDG.
Yep.
And then you've recently changed to Ridge. So why?
So I was hoping to come up with a really exciting story because, following Susan talking about crypto and then switching to SaaS is going to put half the people here to sleep. But the story is relatively straightforward. IDG started off investing in technology as a corporate fund in the late 1990s. That was really successful. Then about 12 years ago, I came in with two of my partners. We raised a couple of funds with outside capital, still keep the IDG name. And what we found over the years is that we ran into a bunch of interesting conversations where the first part of any kind of introduction was explaining how we're not a corporate venture fund, then explaining how we're not part of a Chinese investing entity called IDG Capital. So at the end of last year, as we were approaching sort of our next fund, it made sense to come up with a name that actually kind of stood for something that we believed in. And to us, Ridge is a great metaphor of the journey of founders who are trying to reach new heights but have to cross multiple ridges in the process. For those of you who kind of look at the name closely, you notice the letters IDG are still in it. So it's a little bit of our nod to where we've come from.
Mm-hmm. And is IDG still an investor?
IDG is not an investor anymore. IDG's structure has changed completely. It's now owned by a Chinese real estate conglomerate.
Right. And there was a connection, I guess people had access to some IDG platforms before.
Yeah, part of the reason that I was excited about partnering with IDG, so for those of you who are too young in the audience to remember PC World, that Cromwell and I remember fondly, IDG was a great tech media company touching a lot of buyers of IT, and we found ways to use that to the advantage of portfolio companies. That operational benefit still exists as part of the new fund. It's just not tied to our capital source. Mm-hmm. So we separated where the money comes from versus the benefits we provide to the portfolio companies.
Mm-hmm. So how much do you have under management at this point?
So it's about 400 million.
Mm-hmm. And so what's your focus? I know our topic is SaaS, but SaaS seems to touch everything these days.
Yeah, I don't think there's a fund in the Valley who doesn't do SaaS. So the way that we think about what we do is fivefold. So first and foremost, we focus by stage, and we are classic early stage investor. To us, early stage means the very beginning of customers paying money for the product. So this is when this great vision and awesome PowerPoints actually turn into contact with the customer. And we think that's a really important inflection point for creating value, for showing that what you've built actually resonates with the paying customer, whether on the enterprise side or the consumer side. So secondly, we focus by sector. We're predominantly an enterprise fund, which these days means a lot of SaaS, some cloud infrastructure, some business-to-business services that are powered by software, as well as some select consumer businesses that reinforce how we think about software kind of changing the world. So third, we have a particular bias towards certain kinds of management teams. We believe that in the enterprise world, prior experience matters a lot. There was a study, I think actually an MIT study came out a couple of weeks ago saying that the median age of a successful founder is 41, which points to about 20 years of experience prior to starting a successful company. And 80% of the founders whom we've backed actually have prior relevant experience, oftentimes as a founder, because our sort of investment philosophy is when we go to back a team, we want to be able to see in our mind that we can back this team for at least a decade. Fourth, there's a very particular kind of deal that we seek to make. And as we think about the change in the venture ecosystem, and I talked about this earlier, when I first started in venture in early 1990s, a $100 million fund was called a mega fund. In 2018, a $100 million fund is called a micro fund. And that's not an exaggeration. So the world of ventures got much larger, much more institutional. So if you're a founder looking to raise $5 to $10 million for a first round of capital when you have a couple of paying customers, you actually find far less interest in the venture community today than you would have found 10 or 20 years ago. We specialize in those rounds where we invest between $3 to $5 million into a $5 to $10 million round. We tend to be pretty flexible in ownership. It's usually in the mid-teens. And then lastly, we try to find those companies where we can bring substantial revenue to the business. I mean, there are, venture capitalists always talk about value add, and you can debate how much of that really happens. But in our case, the one place we're really focused on is can we bring you paying customers? And we've put together a couple of advisory councils of CIOs and CMOs from Fortune 500. We have about 70 of them represented. We get our portfolio companies in front of them. And last year, we've had companies, 40% of whose revenues come from those introductions.
Can you give an example of a company that you've invested in that's using SaaS in an interesting way?
So it sounds like you're asking for an example of something other than a pure SaaS business, right?
Right.
So we have an interesting company called Uplift, which provides point-of-sale lending for the travel vertical. So they partner with travel providers like United Vacations, Southwest Vacations, big travel providers, and are helping them provide financing for larger travel purchases at the point of sale. It was started by a group of very technical founders who've come from the vertical of building applications for the travel industry. And if they engineer the product in such a way that 100% of the credit decision is automated. So they're actually using software to integrate with the entire flow of the travel provider. And when the consumer is interested in applying for a loan to finance this travel, that decision is made by the software they've written. So it's 100% SaaS powered, but they're not getting paid as a SaaS provider.
Because of the way you asked me to define what I was asking, can you give me an example of a pure SaaS company that you're involved in?
Sure, and one of the things that that I love about this business is because of the massive changes that take place in the underlying infrastructure every 5 to 7 years pretty regularly, you're able to find really interesting businesses to invest with a pretty regular cadence that could not have existed 5 or 10 years ago. We made a recent investment earlier this year in a SaaS company called Outlier that is pioneering category of predictive analytics. And what that company is able to do is connect to all the various data sources that a company has. So think of your Google Analytics, think of your CRM, think of your Zendesk, think of your accounting system. Suck in all that data, transform it into a massive time series database, and then look for outliers based on patterns of past behavior across millions of microsegments of customers you didn't even know was a segment. And then looks for patterns and for outliers, hence the name, and deviations for patterns. So it's able to tell you whether, left-handed Russian-born, venture capitalists on the West Coast bought at a higher rate or a lower rate this Monday than they normally do on Mondays.
The other thing that we talked about when we were chatting recently was artificial intelligence and how that is also becoming kind of table stakes with a lot of with new companies.
Right.
Have any of the companies that you've been involved with been applying machine learning and also SaaS and coming up with something interesting?
Yeah, so it's not exactly news in 2018 to say that a lot of companies are applying AI or elements of machine learning or trying to apply elements of machine learning. What I think most people who've actually deployed it and have tried to deploy it for a couple of years will find that it's hard. And it's very hard to find sort of really good use cases. Everybody talks about kind of the obvious ones like image recognition that turns out to be a really great use case for machine learning because you have billions of data points with a known input and a known output. In ad tech, there have been some really interesting companies. We had a portfolio company called Crux, KRUX, which was a leader in data management platform used by marketers on big websites. We invested pre-revenue. Actually, we had one paying customer. It got acquired by Salesforce for $800 million 5 years later. So obviously it worked. But one of the things they were able to do was actually to apply unsupervised machine learning to massive amounts of their customers' data to identify segments of customers that the particular market or the particular website didn't even know existed. So that was a very good sort of application for a non-AI company to actually apply machine learning. A pure AI company that I invested in that was interesting to watch because it was not a straightforward path was a company called MindMeld. It started in 2011 by an MIT AI researcher named Tim Tuttle. His initial version was actually to build something like Amazon Alexa, but the initial product vision was to do it on an iPad. That turned out not to work. But what he was able to do was to identify a need for large enterprises to have their custom versions of a voice-powered AI virtual assistant. So think of Starbucks or think of Comcast or large enterprise like that that wants to have a voice interface that is custom built for its taxonomy and its applications. Turns out you can't just slap an Alexa or Siri in front of that. And through multiple twists and turns, they've built a business, got a bunch of customers, and then were acquired by Cisco last year for $125 million. But that area of building specialized interfaces, I still think is in the early stages, and I think there will be other companies similar to that that are building sort of next generations of those kinds of assistants.
Mm-hmm. You mentioned earlier how long both of us have been involved with tech.
Please don't remind me of that.
And there was an interesting article posted on CNBC last week. Villanova professor was making the argument that we're in a bigger bubble now than we were in the dot-com days, and the end is near. That was almost literally the headline. And he was basing that on a couple of interesting points. A couple of studies out there that argued that unicorns on average are 50% overvalued, and that 76% of companies that went public last year were still in the red, versus 81% back in 2000. How do you see what's going on today compared to what was going on back then?
Well, as I'm sure you know, outlandish headlines get a lot more clicks than rational, boring ones, right? So with that as a backdrop, first of all, I'll say that it's a reality that valuations are up, right? The valuations are up in seed stage, Series A, Series B, late stage. You can look at any report that PitchBook puts out or CB Insights. So the data says the valuations are up roughly 2x over the last 6 to 7 years. So I think that at the later stages, there is more capital. I think everybody's trying to find the next $100 billion valued company. So you have a somewhat rational imbalance between supply and demand. So those valuations tend to go up. And we have a couple of unicorn value companies in our portfolio. I think our unicorns are fairly valued, and I'm not sure about everybody else's. But if you talk about the public markets, I was looking at the numbers recently, and I don't think that we're at all in a comparable situation to the bubble. So because I was investing in 1999, I remember it well. I remember being on a board of a company with $10 million in revenue that had 4 major investment banks vying to take it public. And if you look at the data from those years, so 1999, 370 tech IPOs go public, been in business on average for 4 years, with average revenue of $12 million. Right, $12 million, company been around for 4 years, it goes public. 2016, the last time the data is available, there were 40 tech IPOs. On average, the company's been around for 11 years. Median revenue level, $105 million. And roughly double the percentage of those companies were profitable than were profitable in '99. So just the scale of the businesses is literally an order of magnitude bigger than it was in '99. So no, I don't think it's a comparable situation at all. I don't think the end is near.
Okay. The end is near for us. One last question. Has this growth in valuations affected your ability to find companies at the lower levels and compete? There's a lot of seed investors out there.
Yes, I mean, it's affected us in a really straightforward way. We're paying higher valuations, right? I think that if you look at sort of the imbalance in the number of investors, there are a ton of seed investors where we focus as the next round, which is Series A. I don't think that there is any part of the investing market that is not competitive or doesn't have a lot of investor interest. I happen to believe Series A has slightly less competition than seed or Series B, Series C companies with traction. But you know, it's a great time to be an entrepreneur. It's a great time to be raising money. It's a great time to be building a business.
Well, thank you. Thank you very much.